Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today, we're covering one of the biggest financial stories happening right now, the replacement of Federal Reserve Chair Jerome Powell and what it means for your money. Kevin Warsh is going through his Senate confirmation hearing this week, and if confirmed, he will take over as Fed Chair when Powell's term expires in May 2026. This is a major shift in the leadership of the most powerful financial institution in the world, and the decisions made by the next Fed chair will directly affect interest rates, your mortgage, your car loan, your credit cards, and the broader economy. Quick note before we get into it, everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Everyone's financial situation is different, so always do your own research or speak with a qualified financial professional before making financial decisions. Let's get into it. First, let's quickly establish why the Federal Reserve Chair matters so much. The Federal Reserve is America's central bank. Its primary job is to manage the country's monetary policy, which essentially means controlling the supply of money and setting interest rates. The Fed Chair is the most powerful economic position in the country, arguably the most powerful in the world. When the Fed raises interest rates, borrowing becomes more expensive. Mortgages cost more. Car loans cost more. Credit card interest goes up. Business loans become harder to get. Economic activity slows down. When the Fed cuts rates, borrowing becomes cheaper. Mortgages get more affordable. Consumer spending tends to increase. The stock market typically responds positively. Economic activity picks up. Every rate decision ripples through the entire economy and affects every American's financial life. That's why the identity and philosophy of the Fed Chair matters enormously. So who is Kevin Warsh and what does he believe? Kevin Warsh is a 55-year-old former member of the Federal Reserve Board of Governors. He served on the Fed's board from 2006 to 2011, a period that included the 2008 financial crisis. He played a role during that period, including involvement in the events surrounding the collapse of Lehman Brothers and the sale of Bear Stearns to J.P. Morgan Chase. After leaving the Fed, Warsh became a distinguished economics fellow at the Hoover Institution, a conservative think tank. He has been an advisor to President Trump and was considered for Treasury Secretary before ultimately being nominated for Fed Chair. President Trump nominated Warsh in January 2026, calling him the perfect candidate and expressing confidence that he would be one of the great Fed chairmen. Now let's talk about what Warsh actually believes, because this is what will directly affect your wallet. Warsh is widely described as a financial hawk. That means he tends to favor tighter monetary policy, keeping a close eye on inflation and being cautious about cutting interest rates too quickly. He has been critical of government spending and has written that recent inflation was caused in part by a government that spent too much and a central bank that printed too much. This positions him as someone who takes inflation extremely seriously and would likely be resistant to cutting rates unless the economic data clearly supports it. This is significant because President Trump has repeatedly pushed for lower interest rates. Lower rates make borrowing cheaper, which tends to boost economic activity and can make the president's economic agenda look more successful. The question hanging over Warsh's confirmation is whether he would maintain the Fed's independence from political pressure or bow to White House demands for rate cuts. At his confirmation hearing this week, Warsh addressed this directly. He stated that the Fed must stay in its lane and that Fed independence is placed at greatest risk when it strays into fiscal and social policies where it has neither authority nor expertise. He also said he does not believe the operational independence of monetary policy is particularly threatened when elected officials state their views on interest rates, which some analysts interpreted as leaving a door open to considering political perspectives without being fully controlled by them. He emphasized a firm commitment to fighting inflation, with notably less focus on the labor market than the current Fed has maintained. This signals a potential shift in priorities under his leadership. So what does a Warsh Fed actually mean for everyday Americans? There are a few scenarios worth understanding. Scenario 1. Warsh maintains a hawkish stance and keeps rates elevated until inflation is clearly under control. This would mean mortgage rates stay higher for longer. Car loan rates stay elevated. Credit card interest remains steep. It would be painful for borrowers, but would likely keep inflation in check. Scenario 2. Warsh faces political pressure from the White House and begins cutting rates more aggressively than the economic data would suggest is appropriate. This could boost the stock market and make borrowing cheaper in the short term, but risks reigniting inflation down the road. Scenario 3. Warsh navigates a middle path, making gradual rate cuts as economic data supports them while maintaining the Fed's credibility on inflation. This is probably the most likely outcome given his stated positions and the political environment. What should you personally be thinking about given this transition? If you have variable rate debt, credit cards, adjustable rate mortgages, variable rate loans, pay close attention to Fed decisions over the next 12 to 18 months. If rates come down, your cost of borrowing will decrease. If they stay elevated or go higher, your minimum payments and interest costs will remain high. If you're thinking about buying a home, the Fed's direction under Warsh will be a major factor in where mortgage rates go. A hawkish Warsh who keeps rates high could mean continued affordability challenges in the housing market. A Warsh who cuts rates would likely bring mortgage rates down and potentially reinvigorate home buying. If you're an investor, the stock market generally reacts positively to rate cuts because cheaper borrowing tends to boost corporate earnings and consumer spending. A dovish turn from Warsh, meaning rate cuts, could be a positive catalyst for equities. A hawkish stance could put pressure on growth stocks and rate-sensitive sectors. Here's the bigger picture worth keeping in mind. The Federal Reserve Chair transition is happening at a particularly complex moment for the U.S. economy. There are ongoing concerns about inflation, significant uncertainty around trade policy and tariffs, and broader questions about the long-term trajectory of U.S. debt and government spending. Whoever leads the Fed over the next 4 years will be making decisions in an environment where there are no easy answers. The tools available to the Fed are blunt instruments. Raising and lowering rates affects everything simultaneously and always involves trade-offs. What matters for your personal financial life is not trying to predict exactly what the Fed will do, but rather positioning yourself to be resilient regardless of what happens. That means reducing high-interest debt, building an emergency fund, investing consistently for the long term, and not making major financial decisions based on short-term rate speculation. That's a wrap on today's breakdown here at Capitalists versus Consumers. This is a story we'll be following closely as it develops. If Warsh is confirmed and begins making decisions, you'll hear about it here first. Hit subscribe and turn on notifications so you never miss a report. We're here every week breaking down the financial news and strategies that matter to your money and your future. We'll see you in the next one. Resources mentioned in this video: recommended book on the Federal Reserve, recommended book on monetary policy and everyday life, recommended personal finance book. This video contains affiliate links. I may earn a small commission at no extra cost to you.